We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. My guest today is Bill Feakes. Bill is a Regional Vice President for New York Life Annuities. So welcome to the podcast, Bill.
Thanks for having me, Bob.
It's a pleasure to have you here. For the benefit of our listeners who may not be familiar with you and your work, before we get started, do you mind giving us a brief overview?
Sure, absolutely. So 32 years in the industry. The last 25 of those have been here at New York Life. A little bit about me personally. I grew up in the military. My father was career military. I also served 6 years on active duty myself. 5 of those 6 were actually stationed along the former East-West German and Czechoslovakian borders, to let you know how long ago that was. And one of my favorites, well, most people's favorites when I tell them is, yes, I live at my 40th address currently. Wow. 40th address. So,
well, let me interrupt and say thank you for your service. And I should note too, is it okay to mention that that you're on the cusp of retirement?
Absolutely. So 10 working days left. So I've been talking about retirement with other people for over 30 years. I thought I might give it a try myself.
All right. So one last question before we get to the topic of the day is, are you retiring to something?
I have a lot of plans, but initially I plan to do nothing, just for a short break, about 30 days, and then I plan to go full steam ahead after that.
All right. Well, that's certainly retiring to something. All right.
Yes.
So the topic today, Bill, is market volatility, and everyone wants to get a sense of the current environment. And what's your take there?
Yeah. So I think that we all know that the market does not like uncertainty. We've got a little bit of uncertainty out of the way over the last week or so with the election. So still some questions need to be answered, but we have a better feel for where we are with that. But one outstanding question that we have is inflation. You know, inflation, whether we want to call it stubborn, sticky, persistent, annoying, whatever, inflation looks like it's going to be here for a while. And the Fed has taken some pretty aggressive policy actions, which were warranted. But that's really has probably narrowed the opportunity for a softening of the economic landing, a soft landing. But we'll have to wait and see exactly what happens there. But as far as inflation is concerned, I actually went back, after 30 years, we've always known that inflation's averaged a little bit better than 3. I went back to the source, the Bureau of Labor Statistics, recently, and they have data from 1913 through 2021. So over the last 108 years, the CPI's averaged about 3.2 through the end of 2021. But if we look at the last just 30 years, from 92 to 2021, the last 30 years, it's averaged significantly less than that, about 2.4. And the last 20 years alone, it's averaged even below that, about 2.28%. So if we think of 20 or 30 years, that's a big chunk of most of our careers, or maybe even a part of a retirement, right? So whether it's transitory, whether it's transitional, whether it's a reversion to the mean, look, inflation is always going to be around. And it's just one of those things that can keep us from investing. Having said that, there's a lot of other reasons for not investing, things like market volatility, things for uncertainty of the over the economy, political unrest around the world, geopolitical unrest. Insert your reason here, right? So your clients may believe that sitting on the sidelines is a safer choice, but those that opt out of market exposure to preserve their portfolios, they really may be jeopardizing their long-term performance and realization of their retirement dreams. And we want to help them to avoid that if we can. So what we're seeing right now, Bob, is we're seeing a lot of investors that are looking for different solutions that offer growth potential combined with some protection on the downside. This is a real desire for this type of approach right now. So there are certain annuities, and we'll talk a little bit more about them towards the back end, but there are certain annuities out there today that can offer growth potential with principal protection. And right now, I think that's what a lot of people are looking for. As a matter of fact, in May of this year, we did a survey here at New York Life where about 79% of the financial advisors said that the products that can offer growth potential combined with protection features, this is something that's more important now than ever.
So that's the lay of the land. What's the impact from your perspective?
Yeah, so I think the impact begins probably at the beginning of this year. How did we start 2022? We started with the market at all-time highs, right? And then we quickly moved into something that hasn't happened in decades, and that was a persistent rise in interest rates. I think we all kind of knew this was coming, but we maybe didn't realize it was going to come quite this quickly. But I went back this morning and I looked at Bloomberg and a couple of different points along the curve. I looked at the 3-month T-bill. Really, I looked there because that's the risk-free rate of return. That's what we associate with the risk-free rate of return, the T-bill. That was yielding 4.16 at the time this morning when I looked at it. A year ago, it was trading at 2 basis points. Think of that. 4.16 today, it was at 2 basis points a year ago. And then I looked at the 10-year. The 10-year was at 381. A year ago, it was at 168. So, you know, the yield curve is normally something like this, short end, long end. This is what it looked like a year ago. 2 basis points, 161 basis points between the 3-month and the 10-year. It was straight up. There was no curve. It was just a straight up. But where are we today? Well, it's now inverted. The 3-month is now at 416 and the 10-year is at 380. So the steepness of the curve is now inverted. It's really has changed dramatically. And what has that done? Well, for the first time in many, many years, as I said earlier, 401ks, IRAs, brokerage statements, clients with 60-40 portfolios that they thought were fairly safe are seeing material drops in those balances. Now, in many cases, this has led consumers to call their advisors, and advisors have even called me too and said, hey, man, what's going on out there? This is different, right? What's happening? Well, it's time to maybe take a little bit of pause. We know that bear markets have led to growth opportunities in the past. And if we look at from a kind of historic point on the S&P, I'd draw out a couple of different points. The Great Depression, that was the big one. Then World War II, the oil crisis of 73, 74, the tech bubble of the early 2000s, and then the Great Recession that we all, of course, just lived through. But Bob, you know, a lot has been said about the 1970s because we haven't seen this type of inflation that we're experiencing today in over 40 years. So it's been early 80s, you know, into the 70s before we've seen this. So I went back and revisited a letter that I had written or that I had read from the Chicago Fed back in October of 94. And I just want to quote a couple things from that letter. Again, this is from the Chicago Fed, October of 1994. And this is sort of a recap, sort of an after action 20 years after the 73-74 oil embargo. They said that in January 1973, crude oil was trading at $2.75 a barrel. That was the average price January 1973, according to this Fed letter, $2.75. 14 months later, March 1974, oil had risen to $11.10. Think about that. In 14 months, it doubled from 275 to 550, 550 to $11. That's a double and a double again in 14 months. Mm-hmm. And by April of 1981, it was trading at almost $37, $36.95. So over an 8-year period of time, that was most of the 80s there. That's what caused a lot of this inflation. It went from $2.75 to $36.95. That's like a 13x on oil. Look, prolonged down markets are not typical. We know that. They tend to be followed by periods of growth, which is encouraging. We know that too. But it's impossible to know when the bottom is going to hit. So it's really important to know that we only know in hindsight when the bottom was really in. So what we want to do is we want to try to avoid market timing. It's never a good idea to try and time the market, but by continuing to invest through those down markets, investors can take advantage of bargain prices and benefit from possible future recovery. Incidentally, just for informational purposes, anytime I mention past performance and market conditions, unless I specifically say otherwise, I'm referring to the S&P 500 index as a benchmark.
All right, fair. So what, from your perspective, are the client problems that need solving given that impact?
Yeah, there's certainly some out there. I think one of the first things that we should probably try to do is help clients to keep it all in perspective. We all know that volatility is just part of investing, but we haven't seen a tremendous amount of prolonged volatility in a while, right? And so this time is a little bit different. We're revisiting some history here. Look, volatility can allow us to sit on the sidelines until things calm down, but that might not be the best course of action. What we really want to talk about is we want to talk about diversification and finding the right balance for you. What's right for your client? That's really finance, if you will, but we know it's more than just finance. It's also about behavioral finance. Look, volatility can trigger an investor's fight or flight instinct. We know that. That's why it's really important to use more tools to help manage some of those emotions. And we're going to talk about some of those tools in a few minutes. But right now, I'd like to share maybe a statistic with you, and that's over the last 35 years, 26 out of the last 35 years, the market has realized positive year-end returns, even when there were intra-year declines. So the market was down at some point during the year, but it still managed 26 out of the 35 years to finish with a positive rate of return. Now, is that going to happen this year? Not making that call. Part of the reason is because we finished last year sort of at the market high, okay? But we're making a run at it. So we'll see where we finish the year. But in 26 out of the last 35 years, we've actually realized a positive year in return. Now, when it comes to investing, of course, we want to stay the course. We want to especially talk about times of short-term market volatility. And we know that time in the market, Bob, is really important, right? It's not timing the market, but time in the market, because time in the market helps us to smooth out those returns. Now, historically, an investment during any one-year period of time is going to see more volatility. But if we go back to 1979, and we look at the best one-year performance, it was up 37%. Coincidentally, the worst one-year performance was down 37%. So best 1 year up 37, worst down year down 37. If we smooth out the returns, if we go out to a 5-year period, from 1 year out to 5 years, we've smoothed the returns. The worst 5-year period since 1979 was a negative 2.3% and a positive 28.5%. So similar upside potential, but a lot less downside because time in the market helps to smooth returns. And we want to remind people of that. It's not about the short term, it's about the long term.
Given what's happened, how does one sort of go about assessing and adjusting there?
Right. Yeah, that's a good question. Good question, Bob. So down markets really can present buying opportunities. That's what it's all about. Market swings are common, we know that, and they can be unnerving. We also know that as well. But down markets can present buying opportunities, and we really want to make sure that people are comfortable with that. So investors who attempt to time the market run the risk of missing rallies and missing the best days of the market. Now, you may know where I'm going with this because we've all seen these charts in the past, but if we look at the last 15 years, that's 12/31 of 06 through 12/31 of 21. So the last 15 years in the market, the S&P 500 returned an average about 10% per year over the last 15 years. But missing just the 10 best days, over a 15-year period, cut that return in half, down to 5%. Now, if we talk about the 30 best days, right, out of 15 years, the 30 best days, on average, that's 2 days per year. It's not 2 days per year, but just on average, 2 days per year, 30 days over 15 years, you actually realized a negative rate of return. And so this is why I think so many financial advisors recommend that you choose to put together sound investments that match your goals, your risk tolerance, and you hold them for the long term.
As you think about what's happened this year, and the possibility of missing out on the best days in the market, obviously there's a lot of emotion involved in investing. How do you take emotion out of investing?
Yeah, well, we want to go back to the axiom of buy low, sell high. Now, sometimes that goes out the window when emotions take over. We know that, but we know that's what investing is all about: buy low, sell high. According to a Dalbar study that was done recently, the S&P 500 returned over the past 20 years, returned about 9.5%. I think it was 9.52 over the last 20 years. But the average equity investor, they returned less than that, about 8.13%. And the result was really buying and selling at suboptimal times. And, people say to me, Bill, like 9.5, 8.1, isn't that about the same thing? No, it's not. But what does that really mean? If we were going to quantify that over that 20-year period of time, what would be the impact? Well, for $100,000 invested over a 20-year period of time, the difference between those two yields is an extra $139,000 left on the table if you compounded that annually. Now, according to a study, the same study, I should say, the average equity investor has typically stayed invested in a particular mutual fund, if you will, for about 3 to 4 years. Now, that's going to vary, obviously. During periods of market turmoil, retention rates tend to dip a bit, and that's understandable, right? To the lower end of the range, that 3 years or maybe even a little bit less. But while the markets are strong, people tend to hang on a little bit longer. So we're getting up around that 4 years, maybe even exceeding that 4 years. However, long-term investment products like variable annuities, now these can provide different behavior. In contrast, the mutual fund to a mutual fund investor, I should say, variable annuity investors have stayed in their investments about 9.5 months longer since 2000 than the average. And this, again, going back to Dalbar through 12/31 of 21. Now, of course, variable annuities and mutual funds, they share a lot of common features. And some of them may be a better fit for your goals than others, and maybe they be a good complement to each other. But there are differences as well. Variable annuities generally are going to have higher fees than mutual funds. Variable annuities also offer some insurance features that you may not see in mutual funds. Some variable annuities also can combine the growth potential of equity investing with an opportunity to protect the principal. Now, this can help clients to address some of those emotions of investing.
Talk a little bit more then about some of the tips that you might have for those who might be feeling skittish about staying. Yeah.
I like your choice of words there, Bob, feeling skittish. I can tell you that I felt a little bit skittish this year, and, thinking about retirement, getting up to the goal line. So feeling skittish is exactly right. And I think a lot of us have felt that. But I think helping people to focus on the long-term retirement goals. Now, during periods of market uncertainty, it's really important to go back and revisit that. It's important to help keep market swings in perspective. We know it's part of investing, that volatility. It's always been there. It'll continue to be there. Now, obviously, there's no guarantee that past market trends are going to continue into the future. And experienced investors know that bear markets have historically always been followed by bull markets. And bull markets have tended to rise over the long term. And we believe that that's probably going to continue to happen into the future. But what we want to do is we want to look for growth opportunities while we're seeking to manage that risk, right? And this is really where advisors play a very critical role in helping clients to maintain the appropriate level of equity exposure. And I think that's a really important point to make, is that we can't allow people to not have equity exposure if it's long-term money. We really need to help them to understand that. Now, many retirees are continuing to kind of live in fear of outliving their money. That's the number one concern of a lot of retirees is, will I outlive my savings? And so what they try to do is they try to self-insure against that risk by underspending, sort of limiting their desired retirement lifestyle. And while that sounds good on paper, that behavior alone isn't typically enough to help them to realize those long-term goals. It's important to revisit that asset allocation, especially in times like this. So we want to work in the investors to ensure that their asset allocation still reflects the personal circumstances, including their risk tolerance, their age, their desired lifestyle, and other income sources. We might even call it the household balance sheet. You know, but that's another story. But now is a really good time to discuss some strategies and to help protect a portion of those clients' assets. Look, if we can introduce principal protection into their portfolio, this can maybe give them the courage to invest today and the confidence to stay invested in turbulent waters ahead. So combining growth potential with guarantees is something that we can do.
Right. So I think that's probably a good segue to talk about some of the product solutions.
Yeah, we have a few of those here at New York Life, but we would talk about a couple of different periods in time here, and these are for retirees and pre-retirees. But one horizon that we would look at is out typically about 10 years or longer, right? This isn't grocery store money. This isn't the light bill money. This is money that you're going to spend probably 10, 15, 20 years later, a longer horizon. And so one solution for those folks to help get them into the market and stay invested in the market may be a variable annuity with an accumulation benefit rider. So what this is it's really guaranteeing the principal amount for a period of time. Maybe that's 10 years out into the future as an example. So your $100,000 invested today is guaranteed to be worth $100,000 10 years from now. But one of the benefits there is that you have the ability to reset that on every anniversary. Now, not all these are out there, but that's something that's out there today. You have the ability to reset that. So if your 100,000 grew to 120,000, you still had a 10-year time horizon there, you could lock in 120 so that 10 years from now you got 120 in cash. And so for a part of your portfolio to add a principal guarantee, this seems to make a lot of sense to some people. Right. Again, it gives them the confidence to get in the market and stay in the market through those turbulent waters. Now, we would say that the rider does not protect the owner's investment from day-to-day market fluctuations. That's going to go up and down in value. This is the true benefit, is that it gets you in the market, keeps you in the market, and if the market's down 10 years later, you get your money back. This actually did happen in 99. We all know that Dow 10,000 happened at the end of March of 99. 10 years later, it was March of 09, and the market was below that. So these things do benefit the client by not only helping them to get invested in the market and stay invested in the market, but they do pay off too in very turbulent times like that. So the rider, it really is a benefit if you keep it for the entirety of the contract. Okay. Now, for those clients that have maybe a little bit shorter time horizon, maybe that 5 to 7 year time horizon, they're looking for some equity exposure, but maybe they're not looking to jump fully into the market. So there are options available there for them. One might be a hybrid indexed linked variable annuity. This is going to offer index linked accounts and variable investment accounts. Here, what you can do, Bob, is you can protect up to 100% of your money inside of an indexed linked variable or index linked account. So you can't lose money. You may not make money for the year if the market's negative, but you don't lose money. Or you can invest up to 100% in the money in the market, so you have uncapped returns on that side. Or maybe you find some allocation, 50-50, 60-40, 70-30, whatever is right for you and the client. You can really customize it to that solution. I would have to say, though, that clients should be reminded that investing in equity markets definitely contains market risk, including the possibility of principal loss. And we would often say that we want to refer to clients to the appropriate variable annuity product and fund prospectus, and remind your clients to read this prospectus carefully before investing.
Mm. So, Bill, we've covered a lot of ground. Anything that we missed or anything that you think bears reemphasizing before we wrap up?
I think one last thing that I would sort of mention is because inflation has been so persistent and on top of mind, it costs so much more to go to the grocery store, fill up the gas tank than it has. Now is also a good time to talk to people about their income needs. And another income solution or annuity solution that we have are guaranteed lifetime income annuities, often referred to as SPIAs, single premium immediate annuities. We're seeing a vigorous interest, I think we could say, in guaranteeing some additional income that's not correlated to the capital markets. So I would also mention that.
Yeah. Just a quick follow-up on that. During the period of zero interest rate policy, folks maybe didn't look at SPIAs as much as they might now because of the rising interest rate environment. Is that fair to say?
I would say that is fair. We continue to do brisk business throughout those periods, but even more so now. Obviously, rates, we haven't seen rates like this in 14, 15 years, and you haven't seen payout rates on SPIAs in probably about the same amount of time.
Right.
So if you haven't looked at them in a while, I would seriously take a look at them.
Right. And I'll throw out one more question. Oftentimes we get questions around deferred income annuities. Any thoughts about that as a solution?
Yeah, so that's the cousin, if you will, of the SPIA. So DIA, deferred income annuity, and this is really for the client that's concerned about sequence of returns risk. They're within typically 2 to 10 years of retirement. They want to guarantee an additional $500, $1,000, whatever it is per month to cover their basic expenses, and so they use the DIA. It is a fixed annuity. It is going to pay a guaranteed set of income. Basically, it's a pension-like income, if you could call it that. And you know exactly what you're going to get, irrespective of what happens in the capital markets. You know exactly what you're going to get. Sort of as an offshoot to that, there is, since 2014, these have been around, QLAC, Qualifying Longevity Annuity Contract. And so the IRS back in July of 2014 changed, I think it's code 401A9, that allows the IRA owner to move a portion of their IRA assets into this thing called a QLAC, Qualifying Longevity Annuity Contract, and they can defer income on that. They don't have to take any RMDs, no income on that, until they're 85 years old. So really, this is buying longevity insurance for the later years, okay? And so that's something, too, that has seen a rekindled interest. It was very popular when it first came out. Then it sort of didn't go away, but it wasn't quite as popular. But now we're seeing a much more renewed interest in the QLAC as well.
Yeah, it strikes me that advisors need to avail themselves of all the possible tools in the toolbox as they think about building retirement income plans for their clients, or just financial plans in general, or investment plans, given all that's out there.
Right. Yeah, I couldn't agree more with that. I know some people say I'm not in the annuity business, but with trillions of dollars of annuity reserves out there, your clients already own them. So sort of by proxy, you are in the annuity business. It's just, are you going to take care of your client with that, or is somebody else going to take care of the client with that? But you're sort of already in it.
Well, Bill, I want to thank you for sharing your knowledge and wisdom with us. I want to wish you well in your retirement. I hope perhaps you'll come back on and chat with us about what you're doing in retirement after the 30 days are up.
Yes, that would be fun. That would be a lot of fun. Hey, can I just throw our sales desk number out there? Is that okay?
Of course, yes.
Okay. So our sales desk number, 888-474-7725, option 1.
Great. Thanks again, Bill, for
Thank you.
Sharing everything with us.
You bet. Thanks.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.